Scientific evidence is compelling. Human-induced climate change is happening. What that means is that we need to reduce greenhouse gas emissions dramatically.
Sarasin pioneered this idea of Paris-aligned accounting.
We feel we're doing the right thing for the world, the country and our recipients.
If we are going to provide the funds for savers in the future, we absolutely cannot do that in a world where we've destroyed the climate. Well-run companies that manage their relationships with the climate, with their stakeholders well, do better.
Sarasin understood early on the fundamental repricing and reallocation of capital that climate change dictates.
Sarasin's Climate Active Fund, and actually other funds that have been trying to do similar sorts of things, they are outperforming. And they're outperforming because if we solve this problem, then those dirty companies that have been avoided are ones that will not do so well, and the other companies will do rather better.
It's become very clear that climate change is one of the massive challenges facing the world, facing this country, and facing in a very practical way and giving challenges to the people who receive our grants.
It will be the poorest and most disadvantaged countries and people which will find it hardest to adapt and be affected the most.
Sarasin understands that a company's vulnerability to climate transition is as important a determiner of value as changes in interest rates or creditworthiness.
We recognise that we can have a much more powerful voice by collaborating with other charities and investors.
We're very happy with the process we've been through. We're very happy with the support Sarasin's gave us, and we're very happy that now we're in the right position on climate change.
It's been different, it's been in the vanguard, and I think what it's doing is very important.
This is a strategy that takes stewardship really seriously, that recognises shareholders as owners and engages with management teams to align corporate strategy with the goals of net zero.
If greenhouse gas emissions are not reduced, all sensible scenarios point to climate-induced catastrophic change.
But this is going to be done by fund managers treating seriously their responsibilities. And that's why I have always had such an interest in what it is that Saracens are doing.
So, good morning everybody, and thank you for joining us today to mark the 3rd anniversary of the launch of our Climate Active Endowment strategy. Now, lockdown, I'm afraid, means we are going virtual once again, but rather than talk to you from my desk, I thought it would be more interesting this morning to pick out a few of our local renewable energy sources. Now, given I'm talking to you from Hampshire in the Test Valley, that means water mills and water power. Where I'm talking to you right now is outside Beer Mill. Now, Beer Mill is famous because it's where Hugo de Portal back in 1718 started his first paper mill, which of course became world famous for the quality of its banknotes. Now Portals, which became De La Rue, is still operating from a factory a few miles away, and while we don't have 300 years of history with the Climate Active Endowment strategy, it has been a quite extraordinary journey over the past 3 years. You were kind enough to give us 125 million to back the strategy when we launched it, and that sum has now grown to 900 million and is supported by an increasingly wide range of clients. And you're going to hear about the impact that your money has had, as well as the performance, from a range of speakers this morning. It's not just Sarasin and Partners colleagues, but actually people from industry and from academia, and I hope you will find it a fascinating set of talks. Now, being a virtual event, I'm afraid all the talkers today have been pre-recorded, but there will be an opportunity at the end for some live questions and answers. So please stay around and bring us some challenge, and you'll be able to ask questions of all the speakers a little later. So on that note, I'd like to hand over to Christopher Stevens. Chris is the chairman of our independent advisory committee that oversees the charity authorised investment fund. So thank you in advance for the time you're going to give us this morning, and at that point, over to you, Chris.
I'm delighted to welcome you to this virtual Climate Active event. My name is Christopher Stevens. I am the independent chairman of the Committee for Sarasin's Climate Active Endowments Fund. I was appointed as a person with experience both of pension fund trusteeship and a former chairman of a substantial charitable foundation. The role of this committee is to represent the interests of investors, to monitor the progress of the fund, and to hold Sarasin to account. We're looking for two vital ingredients. First, the investment returns that meet and exceed investors' expectations, obviously a critical priority. But second, and equally important, we look for evidence that Sarasin is fulfilling its commitments to investors in pursuing the climate change agenda. My hope is that you will be convinced this morning, as I am, that we're making real progress on both the investments and climate change. In February this year, the fund had its third birthday. During these 3 short years, it has returned capital growth of just over 33%, an average of 11% each year. This, we are pleased to say, is ahead of the benchmark, it's ahead of its peer group, and it's ahead of the long-term growth target of inflation plus 4%. I can confirm also that the fund achieved these returns while actively pushing companies to address climate change. Our committee has worked closely with the Climate Active Advisory Panel, a group of independent experts who work with Sarasin to identify climate change priorities and risks. Professor Cameron Hepburn of the University of Oxford and Heidi Hellman, head of strategy for Centrica, both members of this panel, will speak this morning. I've been lucky enough to attend all their panel meetings since inception, and I have seen just how seriously the Sarasin team takes the advice that they provide. I've been hugely impressed at their knowledge and expertise. Once you have heard them speak, I hope you will be impressed too. We've also benefited from the active and constructive engagement of Natasha Landell-Mills, who heads Sarasin's sustainability agenda. With her small team, they have ensured that the companies in which we invest adhere to the global commitments of the Paris Climate Agreement, and they also ensure that each company takes the necessary steps to move towards net zero carbon emissions. The impact and influence of this programme of work has been wholly disproportionate to Sarasin's size as an asset manager. In other words, Sarasin is punching way above its weight in nudging the corporate world to wake up to the gravity and the urgency of the climate crisis. As Natasha and Ben and Alexander speak this morning, you will again be able to judge this for yourselves. Do enjoy the brief presentations that follow, and please ask questions in the live Q&A session at the end. It's a great opportunity to hear from some genuine experts, and we start now with Professor Cameron Hepburn.
Hi, I'm Cameron Hepburn, Professor of Environmental Economics and Director of the Smith School of Enterprise and the Environment at the University of Oxford. And It's a pleasure to reflect on the amount of progress that has been made over the course of the last 3 years since the Sarasin Climate Active Fund was launched, because there has actually been an awful lot. I mean, in the last 3 years, the concept of net zero has really properly established itself. It's so well established now that it's kind of hard to believe that it was only a few years before Sarasin launched that I found myself at the World Economic Forum meeting world leaders and arguing with them about whether this was accepted science and even a good communications idea. And of course it is both. And since then, we've now had one economic grouping after another, commit to net zero, the EU, now China, and soon the US on a federal level. And it's very clear that this is not only where the world has to head, but it is where the world is going to head. And now the only question is how fast. We know that getting to net zero by 2050 is a huge undertaking across multiple systems, and none of this is going to be easy. But we also know that there's a set of stepping stones along the way. Clean up your electricity system, electrify a lot of the economy. For the bits that you can't electrify, make sure you're using clean molecules like hydrogen from electrolysis. Go hard on efficiency across all areas, industrial and buildings and the rest of us. And we're going to need a transformation of food and agricultural systems as well. And the economics of all of these transformations are improving now incredibly quickly. There's a positive story here from multiple angles. And partly this is due to the self-reinforcing dynamics that we're seeing coming into play here. So it's not really surprising that investing in this transformation has already been rewarding, as the Sarasin Climate Active Fund has shown. And I think investing in these themes will continue to be rewarding for the coming years and, I dare say, decades. If we first have a look at some of the detail of the progress since Paris, here the Climate Action Tracker report just released in December shows that since Paris and since the 3 years of the Climate Active Fund, we've had big increases in ambition and, in fact, in implemented policies around net zero. So you can peruse that slide at your leisure. It's quite a good one. But the bottom line is that while 5 years ago we were looking at temperatures well over 3 degrees, we're now in a situation where if all of the countries of the world deliver on their net zero announcements, we are within spitting distance of a 2-degree target. Now, of course, Paris, the agreement looks for well below 2 degrees, aiming at 1.5, so we're not there yet. But this is starting to feel like a story heading in the right direction, whereas it hasn't for the last 20 years, I dare say. So let me take you through some of the dynamics at play here. And if you take a system, whether it's a socioeconomic system or a physical system, here actually an ice sheet is part of a system, you can get these reinforcing dynamics in systems where once things start to happen, they really take off exponentially. We heard mid last year that there was some risk that this ice sheet would now be lost irretrievably, because as the temperatures warm, the ice obviously melts. You'd have to cool the Earth to 1 degree below where we were pre-industrially to get those sorts of sheets back. Now, it's not going to happen immediately, but these sorts of dynamics are nasty, and they're in the system. And you could spend a long time, and many of my colleagues happily at Oxford do, studying the mathematics and the dynamics of these systems, but it's enough to know that they play out as well in socioeconomic systems. Here, of course, the collapse of the Berlin Wall, where a set of small changes triggered massive changes, including in the fall of a system of thought, effectively, and radical changes across the economies of Eastern Europe. So this positive feedback is very important in social systems. It's particularly important in the transformations that we're seeing towards a net zero future. And we could spend a lot of time together going through the sheer array of different positive feedbacks there are on this path to net zero. I put 9 in front of you now, thinking about technology. More deployment of clean technology leads to becoming cheaper, which means you want to deploy it more. A causes B causes A. The same thing can happen on beliefs. If more people think that we're going to get to net zero, then they'll behave in certain ways that actually make net zero more likely. So these beliefs can be self-fulfilling. And across the list here, finance, geopolitics, business, network economics, legal liabilities, even personal preferences and choices about food and diets, all are going to add up, I think, to an increasingly rapid acceleration as time passes. So what do these pathways potentially look like? Well, if we're going to get to net zero kind of on time, well below 2 degrees of warming and within a reasonable shot at 1.5, then we need very sharply declining emissions over the next decade. And we're also going to need some greenhouse gas removal technologies at the end of the decade. That's a large, as yet nascent field. But it's worth keeping an eye on, because what we're talking about here is the growth of an industry in 3 decades that basically is as big as the oil and gas industry today, kind of operating in reverse, taking the carbon out of the air and putting it back underground. And at Oxford, we're taking particular interest in this space as well. So that's the picture in front of you for the world as a whole from the IPCC. Various illustrative pathways there to get to 1.5 degrees with or without overshoot. In the UK, you can see here, these pathways are fixed by law now. The carbon budgets, which the Committee on Climate Change provides advice about, are legislated, and then the government is held to account to deliver on a plan to get there. Now, of course, government's not always on track with these plans. It's met all 3 of the budgets so far, but without further action, looks like missing budgets in the future. So, but of course, part of the institutional structure is designed to ensure that it is under pressure to deliver. Now, what needs to happen to get to net zero, as I said earlier, is much clearer. Lots of efficiency there in purple. Take up of low carbon solutions, electricity, hydrogen, and carbon capture. Expansion of that low carbon energy, and then some offsets. And we're now in a point in time where a company such as Shell feels compelled to have, and it is sensible for it to have, scenarios that are around the 1.5 to 2 to a bit over 2 kind of mark in terms of warming. All signals that we're heading on the right track. So what are the opportunities for investors? Clearly, the first thing you should do is make sure that you are holding high carbon stocks with caution, and ideally with some sort of sense that you can be transformational and agents for change in their pathways. Of course, the Sarasin team have been doing over the last 3 years in their very intelligent and activist way. But also there are these other clean technologies that we know are going to grow exponentially, whether it's high efficiency forms of renewable energy, electrolysis, some of the other industries that need reshaping, like the steel and the cement industry. And of course, once we've got lots of hydrogen that is clean, that can be used with captured CO2 to produce other products and potentially even synthetic foods. And you know the story about cellular agriculture and plant-based alternative proteins. So these kind of stories in food, in energy, are simply going to accelerate. It's an exciting time to be investing in this space, and I'm looking forward to the discussion later on. Thank you very much.
Cameron, thank you. Those of you who have supported our Climate Active Paris-aligned approach can actually stand tall, because it's not just about the assets you've given us to manage. It's actually about the entire $17.5 billion that we at Sarasin & Partners manage for all our clients, because the extra research we've been able to bring on board as a result of the Climate Active assets have actually resulted in almost the entire $17.5 billion divesting from conventional fossil fuel companies, and indeed a few other non-extractive industry companies which we simply don't think will be able to survive sustainably and profitably in a world where climate change is all around us. Now, I'm standing outside the silk mill in the centre of Whitchurch, and as the name suggests, it's quite a rare beast. It neither works with corn nor wool, it actually weaves silk. And again, sustainable energy from the water wheel behind me driving all their looms. Now that silk and thread takes us back to Natasha Landell-Mills, who is going to talk next. As part of our holistic approach, we combine thoughtful and targeted engagements with ultimately divestment if that is the approach that we feel works best. Natasha is now going to focus on why and how engagement with investees companies has and can continue to be impactful talking through some of the worked examples that your capital has helped us engage with.
Active engagement is a core part of the Climate Active strategy for two reasons. Firstly, because we believe that to get to net zero by 2050, everyone needs to act. And secondly, because we believe that investors can be catalytic in driving some of the largest businesses to commit to getting onto a net zero by 2050 pathway. But what does an impactful engagement look like? What are the key ingredients for success? I'd like to spend the next few minutes giving you a window into this very important issue. So let's kick off with some basics. Capital allocation is absolutely vital if we're going to get to net zero by 2050. We need to see investment withdrawn, phased out from fossil fuel activities, and we need to see investment massively scaled up into cleaner alternatives. So to do this, we can act at two levels. Firstly, we can allocate on your behalf capital into different businesses and choose those businesses which are aligned with Paris. Secondly, we can do this by pressing boards of companies to make sure that they are deploying capital, including the capital that they generate organically, into projects which are aligned with Paris. Climate Active acts at both levels. We invest to protect capital in a way which is aligned with Paris, but also we are actively engaging with boards to ensure that they align with Paris. So let me take that second element and look a little bit more detail. What are the key ingredients for success? The simple truth is it's very complex. We're looking at a broad ecosystem and we need to understand that ecosystem and we need to identify the pressure points within it. So at a company level, we need to understand what are our rights, how much access do we have to the board, what can we vote on, can we co-file shareholder resolutions, do we have access to the auditor? For our peer investors, can we work with them? Do they share our goals? Have they deployed resources and are they willing to act in the way that we are? The public view and the media are also very important. Will they be supportive of our efforts? Will they help us draw out the key concerns that we're highlighting? And finally, the policy framework. Are governments passing policies and regulations that will drive net zero behavior? And if they are not, can we help to catalyze that? And above all, for a successful engagement, we need to have a winning argument. We need an argument that all of these different stakeholders can get behind, because the more support we get, the greater our influence is. Let me try to bring this to life with a very real example of BP, the oil and gas major. Now, we'd been engaging with BP for some time before Climate Active was launched. But with Climate Active, we significantly stepped up our activities. We identified a key pressure point, which was we felt BP needed to adopt net zero accounting if we were to ensure that it would have behavior aligned with getting to net zero. In other words, the numbers drive behavior. We drew together a collective of around 1 trillion in assets behind this argument, and we wrote to the audit committee chair and we copied it to the auditor Deloitte. We set out not only the regulatory context, which in our view was supportive of ensuring that climate risks were embedded in their accounting, but also our expectations that they did so. The impact was dramatic. In the next set of annual report and accounts, BP lowered one of its key critical accounting assumptions, its oil price assumption, but also Deloitte set out that despite BP lowering its oil price assumption, this didn't go far enough to be consistent with Paris. That then led to, in our view, several weeks later, the board publishing a press release in which they stated henceforth they would be using Paris-aligned accounts, and therefore they anticipated an impairment of between 13 and 17.5 billion dollars. In other words, roughly around 20% of their reported equity at that time. It was in the autumn then that the new CEO set out their new strategy. And for the first time, BP projected that fossil fuel production would decline by 40% by 2030, and they would be scaling up their renewables investment. Now, this doesn't go far enough, of course, And strategies have a whole range of different inputs and influences, but there can be no doubt, in our view, that having Paris-aligned accounts has been really instrumental in helping to support their shift towards decarbonisation. So what are the key ingredients for success here? First, the power of the argument. Net zero accounts driving net zero behaviour is gaining a whole lot of traction. Indeed, what we also saw, which has been really important, is the market standard setter, so the International Accounting and Audit Standards Board, issued guidance setting out how climate risks now need to be considered in accounting and audit. Deloitte, the auditor, was also instrumental. In our view, them highlighting that BP's assumptions were not Paris-aligned was the key factor behind the board then issuing a press release to align those assumptions. And finally, the volume of support that we got from other investors, which is of course linked to the power of the argument. Our support on this issue of net zero accounting has grown from 1 trillion at the beginning of that engagement to over 100 trillion today. BP, whilst is no longer held in Climate Active, has enabled an enormous ripple effect. Not only have we had parallel engagements in Shell and Total equally successful, but we are seeing other investors across the ecosystem picking up this argument and writing to audit committees to seek Paris-aligned accounting. So we no longer hold oil and gas in our Climate Active strategy, but we are pursuing active engagement across a whole range of sectors, whether it's the power sector, industrials, and indeed financials. Most recently, we've had an enormous success at HSBC, where the board, following our shareholder resolution, agreed to all of our key demands that their financing needed to be aligned with Paris and they needed to phase out financing of coal. We are anticipating that to be adopted at the next AGM and to be put into their Articles of Association. So let me end with a few concluding remarks. To get to net zero, we all have to act. In our investments, we should be aligning these with companies that are on a pathway to get to net zero, but we also need to be engaging with boards to make sure that they are moving their businesses onto a pathway that gets to net zero. For engagements to be impactful, having a powerful argument is mission critical. That is what drives getting the broader stakeholder community to support you. But we also need an investor base that has teeth, an investor base that is willing to use the levers that they have to drive change. And then how do we know in the end whether we've been successful? It's not always easy to attribute a success to a particular input. But I think what we would like to see is companies that align with Paris, but we also need to see the system aligned with Paris.
Natasha, thank you. I think worth noting, since Natasha's piece was recorded to camera, that we've actually been named in the most recent report and accounts produced by Shell. Shell has acknowledged that we have worked with them to help their accounting policies and to create a more prudent and accurate set of accounts going forward. Now, I've moved to a fulling mill, slightly downstream. The fulling process is all about thickening and compacting the wool ahead of use. There are numerous fulling mills up and down the country, and it's relevant because of their use of tenterhooks. I hope you're all hanging on tenterhooks ahead of the next speaker, Heidi Hellman. Heidi is a member of our Climate Active Advisory Panel, and she actually works in the oil and gas sector, and thus is an incredibly helpful person to bring us insight into how companies in the sector react to their engagements with an active investor like Sarasin & Partners. So over to you, Heidi.
Hi, good morning. My name is Heidi Hellman, and I head up Group Strategy and Environment for Centrica, a company that many of you may know better as British Gas. So we are a CDP A-rated company, and we've recently accelerated our net zero target to align with 2045. So we're well on our way in our journey to be more sustainable. But I should say, as we've gone through that journey, we've had a lot of help as well as a lot of challenge from many of our stakeholders. So not just shareholders, but also auditors and credit rating agency, as well as regulators. So it's in that context that I have the pleasure to talk to you about what it's like to be a corporate going through this transition. So the first thing I would say is I think most companies want to do the right thing. They want to be more sustainable. This is because it's what our customers want, it's what our investors want, but it's also aligned with the government's ambitions around net zero, and it also helps us to attract and retain the talent that we need and want. So companies want to do the right thing. And then I guess the question is, well, what stops us or what slows us down? And I think there are 4 challenges, really. The first one is just the uncertainty. Companies are being asked to make decisions and investment choices without knowing exactly how the future is going to play out. We know we're on a journey to net zero, but what we don't know is exactly which pathway we'll take to get there. We don't really know which technologies will win and which ones will lose, or which new technologies might emerge that we don't even know about today. So that uncertainty makes it hard to make choices. The other aspect of the uncertainty is around the timing of some of the big shifts that are coming. We know that customers adopt new technology along an S-curve, but what's hard to know is when will that peak in the curve happen? When will that shift take place? And if you move too quickly, you run the risk of destroying value in your existing business. If you move too slowly, then you run the risk of stranded assets or simply falling behind your competitors. So those aspects of uncertainty make it difficult. The second area is around the time horizon itself. The transition is taking place over decades, 20, 30 years, and it's unnatural for companies to think in that time frame. We tend to think a couple years out, maybe 5 years out when we're thinking strategically, but to think about our business or our sector, what it's going to look like in 20 years is something that's really quite uncomfortable for most companies. So that's the second challenge that we have. The third is around financial returns. So although it's not true in all cases, in many cases, being more sustainable requires additional cost, or in some cases, accepting lower financial returns. And that's hard for companies. We have to realize that many of these new technologies are still evolving. The profit pools are small and the business models are still developing. So it's hard in many cases to know how to monetize these new areas. So that's the third challenge. The fourth is simply competing priorities. So it's not just the energy transition that companies are having to grapple with. In many cases, they're still dealing with the impacts of COVID. We're having to deal with digital transformations, company restructuring, as well as new regulations that may or may not relate to the net zero transition. So all of these things are competing for time and resource within a company. So how can investors help? Obviously, they can't make all these problems go away, but they can help to address some of them. I would say just by engaging, particularly when that engagement happens at the board or the executive level, helps with the issue of prioritization. So keeping ESG matters at the top of the agenda is something that's hugely important and that investors can help with. It's also something that people working down in the organization can use that are trying to bring about change. They can leverage that engagement that comes from our investors. The second benefit that comes from the engagement of investors is providing a mandate to companies. So to this issue around both the uncertainty as well as the concern around financial returns, having our investors say, we understand the risk, we know the uncertainty, but this is still the direction we want you to go, provides comfort and support to companies that they are making the right decisions. And that's hugely important. The other area where I think investors can help is working with companies to help lobby governments for clear and consistent and sustainable policies that underpin the transition. This is something that's hugely important for companies as they're making decisions. We need that certainty. We need as much clarity as possible on how this will evolve. And I think to date, we found a lot of the engagement from investors is focused on trying to encourage companies to change, and that's important. We need to continue to do that. But I think even more value could come from working jointly with companies to help influence the government to ensure we get the new policies in place that we need to enable this transition. And then lastly, I would say the other areas in which investors can help is around setting clear expectations. So how are our investors assessing us on ESG matters? There's a profusion of tools and metrics that are coming out now, whether it's CDP or TCFD, Sustainalytics, SASB. And if everyone uses a different metric, it does create a certain inefficiency and makes it harder for companies to maintain the transparency that's being asked for. So I would say one having that clear expectation of how you're assessing companies, but also to the extent possible, having coalitions or standards that bring that together so that there isn't this profusion of metrics out there. That then leads to the last question, which is all this engagement having an impact? And I would say absolutely. Our shareholders have huge influence with the companies that they invest in. And we're seeing a significant increase in that engagement over the last couple of years. If I think back to 4 or 5 years ago, we had 1, maybe 2 requests a year for engagement on ESG matters. But I would say in the last year, we've had probably more than 20 requests for that. So almost an exponential increase in terms of the level of interest on ESG matters. And obviously, we try to engage with as many stakeholders as we can. We do tend to naturally prioritize those that are either larger shareholders or those that represent groups of shareholders. Or in some cases, if they are particularly influential on an area that's important to us. So for example, at the moment, just transition is one. So I would say 1, the level of interest is increasing, and 2, it is impactful. If I give just one quick example on that, we recently received a letter from one of our largest shareholders. It was addressed to our CEO and had a clear request. They wanted us to put in place a climate transition plan by the end of the year. It's the sort of thing that we've been thinking about in our group environment team, but it hadn't quite percolated up to the CEO level. However, this one letter meant that within a couple of days, we had engagement from the CEO and from the chairman, and we had an agreed way forward. So just that one letter created a focus and an urgency that would have taken months for us to create internally. So yes, it is having an impact. So if I just then close on how does it feel to be a corporate going through this transition? I would say at times it can be frustrating. It does feel like the goalposts are ever changing. It feels like the bar is rising. As soon as you take one step forward, there's another request coming at you. But at the same time, I would say it feels very positive. For the first time since I've been in the sector, all stakeholders are aligned, not just shareholders and corporates, but also governments and customers are all pushing in the same direction. And that actually feels quite good.
Heidi, thank you very much. That was fantastic. Now, I think it's probably time to move on from water mills, which are probably really a power of the past, to something that is a power associated with today and the future, and which can and already has actually made a huge difference. Behind me you can see a really quite significant solar park. It's 155 acres and it's generating about 40 megawatts of energy right now. And while further shifts in policy are needed across the financial and investor universe to ensure that we transition at a pace and at a scale that is necessary to limit the impact of climate change, from an investment perspective, we have to think very hard now about how we can make our capital work as hard as possible, which is why I'm now going to turn over to Alexander True and Ben McEwen to talk us through the investment process and some stock selection thoughts. Thank you.
Hi, Ben.
Hi, Al.
We are now 5 years after the Paris Agreement, or COP21 as it's known. Has the world woken up to the threat of climate change?
Yeah, it's a good question. I think I sort of vacillate between some sense of anxiety. When we think about global emissions, they've risen 4 out of the last 5 years. We need deep decarbonisation to get us in alignment with the Paris Agreement. But certainly the last 12 months have given us cause for cautious optimism about the future.
I sense you might be making reference there to some of the global commitments that were made last year around achieving net zero.
Yeah, absolutely. So we have seen real positive developments over the course of the last 12 months. We've seen the election of a Biden administration that is putting climate change at the centre of its policy, both domestically and internationally. We've seen the EU ratchet up its emissions reduction targets to 55% relative to 1990. And to some extent, we've seen surprise announcements from China with a net zero 2060 target, swiftly followed by Japan and South Korea with net zero by 2050 targets.
That's really interesting and quite reassuring, isn't it? I think maybe taking it away from government level, can you give us some examples of individual investments where you've engaged and indeed had an impact around addressing the threat of climate change?
Yeah, absolutely. I mean, I think, that the policy framework and the international framework is clearly shifting, as you note, but we've also seen a significant increase in the adoption of things like science-based targets from companies themselves. In fact, over the course of 2020, we've seen a doubling in the pace of companies setting targets aligned with the Paris Agreement relative to the 5 preceding years. So this is now a trend that is happening across companies, and it's beyond just the sort of conventional oil and gas sectors that are reducing their emissions. You know, we've seen financial institutions, companies involved in the agriculture and food value chains, and industry participants setting more demonstrably aligned emissions reduction targets. I think the sort of tone has changed over the last 12 months, in fact. You know, previously it was often seen as detrimental to shareholders to embark upon more radical emissions reduction strategies. So, you know, there was a perception that this was going to impact free cash flows for companies. But I think over the last 12 months, we've seen a real appreciation as to the economic rationale of these deep decarbonisation pathways and how important it is to a variety of stakeholders.
Is it fair to say at a portfolio level that if all integrated oil and gas businesses have been sold, everything has been done to address climate change?
Yeah, I mean, if only it was so easy. I mean, certainly our belief at Sarasin and Partners is that one has to take a sort of holistic view of climate change risks and opportunities into portfolios. And so it's not just about divesting from oil and gas firms and then saying you've done everything. I mean, I think the first point is that investors and stakeholders can play a powerful role in changing the capital allocation frameworks of oil and gas companies. So there is, you know, definitely progress that we've seen at companies like Shell, BP and Repsol, you know, materially started to shift their capital allocation away from fossil fuel extraction. You know, some of that has been catalyzed by the investment community. So I think the investment community has a powerful engagement voice. But what I would say is, you know, if capital is still assessed to be at risk from climate change in these firms, then it's clearly the responsibility to divest there. But that really takes us into the sort of the next leg of climate risk and opportunity, which is to say that whether it's a transition risk or an adaptation risk, one needs to think much more holistically about the nature of those risks and recognize that those risks can take place in some of those industries that we mentioned before. You know, financial firms can have climate risk. Industry companies can have climate risk. So one really needs to think about how deep decarbonisation pathways affect all parts of the economy.
I know a number of those organisations that are joining us today are quite keen to make statements their portfolios are fossil free. Are there any words of caution that you'd recommend or put their way?
I think we have to think about it in two parts, and the first part is the extraction part. In most instances, removing oil and gas firms from portfolios will remove the significant majority of extraction of fossil fuels, but there may still be some residual extraction within metals and mining companies or indeed some electric utility firms. But then we have to think about the second part of the equation, which is fossil fuels associated with the generation of electricity, and that is a lot more commonplace. So there we can have to think about, as investors, ascertaining comfort that these electric utility firms are on pathways that are aligned with the Paris Agreement.
That's great. Thanks, Ben. So what does impact mean for you? And particularly as a climate analyst, do you think you have the ability to have positive influence around environmental issues with portfolio managers?
Yeah, absolutely. Again, sort of two principal, I think, vectors of impact for us at Sarasin and Partners. And the first is really the power of engagement, and whether that's in the policy or firm-specific sphere. You know, it is incredibly satisfying to see firms and industries sort of target these more robust emissions reduction strategies, whether that's through the adoption of net zero targets, science-based targets, or Paris-aligned accounts. The second impact is really to demonstrate the power of this holistic view of climate change risk and opportunity for clients and for returns. You know, in the last 12 months, I think we've really seen the power of this holistic view of risk and opportunity and the tangible impact that can have on returns for clients. But what I would say is, you know, I still think that we're in the early days of this movement. When we think about the trillions of dollars, you know, something in excess of $2.5 trillion a year still has to be spent to address mitigation and adaptation. And it's definitely our view that capital markets in some sectors are not adequately pricing the scale and scope of some of these changes.
Yeah, it really is a huge scale of investment up and coming. I'm always amazed that it's 5 years since the Paris Agreement was signed. What have you learned over those last 5 years in relation to engaging with companies and the measurement of impact, and the lessons to be used in the next 5 years, for example?
Yeah, I think probably two elements strike me. The first is the power of having sort of tangible requests when approaching firms. You know, we can often talk about the Oxford Martin School principles or net zero targets, science-based targets, integration of Paris alignment into financial statements. I think those sort of tangible requests are powerful rather than sort of somewhat ethereal climate risk integration. It's also, you know, interesting and quite remarkable how quickly it is changing now to see net zero aspirations be seen as sort of a base level request, whereas once they was perceived as somewhat extreme. And then the second sort of lesson, I think, is these messages are often best received when conveyed in the terminology of sort of tangible risks and returns for companies. And that has definitely shifted. You know, a few years ago, it was perceived that, you know, taking up more robust emissions reduction targets would be negative free cash flow for the company and detrimental to shareholders. But I think over the course of the last 12, 24 months, many industries have shifted. You know, the economic and strategic rationale of deep decarbonisation is now a powerful one.
I find that personally very reassuring, and you know, thanks very much for your time. Hopefully there's plenty for people to think about.
Pleasure. Thanks, Al.
So, welcome to the live element of our Climate Active event. I hope you've enjoyed the talks by the various speakers, and you will now see on your screens that we have a number of them available for some questions and answers on a live basis. So thank you for sending the questions in as we have been talking. And Cameron, I'm gonna kick off with one for you, if I may. A significant proportion of fossil fuel reserves and production are government owned. We understand that managers such as Sarasin Partners can influence companies, but much harder to influence state-owned enterprises. You've obviously in your travels had discussions with a number of oil ministries. The question, to what degree have they changed their tune? What is their approach going to be to the world's reduced use of fossil fuels? Are the majority now ready to play their part? You know, have government attitudes really changed very much in the past few years?
It's a good question, Richard, because it does vary by the country, as you would expect. And the questioner is right that you know, in the immediate sense, that Sarasin isn't going to move national oil companies or national coal companies. But even what Sarasin's doing in the private capital, private equities markets has an impact, because it's changing narratives and shifting understanding of the issue that then filters through to views within national governments. But just to directly answer the question, if I take three categories, starting perhaps with China, you don't think of them as a big oil producer, but they are a big fossil producer, certainly with coal. I mean, their views have shifted dramatically in the course of the last 3 years, even the last 12 months. With the net zero commitment made by Xi Jinping last September by 2060. You know, a couple of years ago, we saw the declines in domestic coal production, but a kind of shift towards the Belt and Road Initiative. You know, if we can't do it at home, we'll do it somewhere else. But even that is now being, you know, brought into line. Perhaps not as fast as it should be, but it's happening. If I move on to the Middle East, you know, I've had conversations with oil ministries where I think I mentioned one actually at the launch of the fund a few years ago, where they were stunned to see that actually some countries did mean it, that we did have to get to net zero, and we were going to get to net zero. And I think, you know, since then you've seen really significant efforts by a number of them, but just to highlight perhaps the Saudis, they could do with some good press. With the NEOM solar and green hydrogen and green ammonia effort. And then going on to my country birth, Australia, it's still pretty messy out there. I think it's one of these bizarre situations where the population and the markets get it, but the government still doesn't seem to, and it's politically very tricky. But even in Australia, I think there's a sense finally that actually, if we don't get our act together, we're going to have our lunch cut by the Saudis and by others. So we'd better become the big country that exports hydrogen up to Japan, or else somebody else will take that market. So there has been movement.
Okay. Natasha, one for you. Climate change, clearly a long-run engagement. Can you update us on any recent developments and what areas you're focusing on at the moment, with the sort of caveat, presumably now you've sold out of the conventional miners, your focus is now going to be elsewhere. So where is your focus going forward?
Yeah, thanks, Richard. I think that's right to a large extent. I just start by saying that it is a long-term issue, but it also requires quite a long-term commitment in terms of engagement. So we will continue to press, particularly on the accounting and audit, and that will also continue to impact the fossil fuel sector where we are involved. But as you say, it's really, really important that we turn our gaze beyond fossil fuels, that we start to look at other sectors. And I would say that applies across the piece. The particular area of focus that we're now really going to step up to is the banking sector, the financial sector. If you like, beyond asset managers, where there is this pressure now for us all to be aligned with net zero. We've seen that, and I talked about it in my presentation with HSBC, but we need to see a whole lot more of that if we're going to ensure that financing across the world is aligned with Paris. So that is where we're going to really focus some attention going forward.
And a follow-up, I mentioned Shell in one of the segues, but I mean, you've caused a huge change in Shell's report and accounts, which we were name-checked in. But do you think that's it, or do you think we'll actually now see a bit of a ripple effect through some of the other oil majors' report and accounts?
Yeah, we already are, actually. So following or in parallel with Shell, we had other engagements. And then last year, with a group of other investors supported by IGCC, we wrote to 36 European companies, and that also included materials and transport companies. And we're starting to see that come through in this year's annual report and accounts. So we've seen, for example, now climate risk for the first time mentioned in Enel's accounts, Air Liquide's accounts, Rio's accounts, CRH's auditor mentions it. So we are starting to see that. And I think probably looking ahead also, one of the striking things about being name-checked by EY in Shell was that they specifically highlighted that Shell's accounts were not Paris aligned. So that then begs the question, well, why not? And should they not be? And I think that is also going to be a question we're going to find elsewhere.
Heidi, with your Centrica hat on, are you able to charge a premium for renewably sourced energy? Is this likely to be a motivating factor for you and other utility companies to pursue?
Yeah, and I think there's increasingly a question around, say, green tariffs and what is a green tariff, and to what extent does it need to be tied directly to renewable energy versus to what extent certificates are acceptable. And so there's probably a need for greater transparency and standardization around just what exactly is green energy. But having said that, I think what we're seeing is there's certainly more interest in having green energy. I think there's probably a small segment that's willing to pay a premium for it right now. Probably the vast majority of people are not. They would have a preference for it, but they're not willing to pay a premium for it. And we do see a slight difference between the business versus the residential side. So businesses, there is more awareness and more willingness to pay that premium, whereas on the residential side, it's still probably an emerging area.
Okay. Alexander, True, a couple for you. A lot of what we've been talking today is multi-asset. The Climate Active strategy launched as a multi-asset strategy. What if I just want you to run my equities? Can you do that?
Yeah, I suppose it's probably worth making clear that climate change is one of the 5 core themes at Sarasin. So That permeates every single one of our investment portfolios and funds. But to answer the question directly, yes, absolutely, we have single asset class solutions, probably best reflected in our responsible global equity strategy, which is entirely aligned with Climate Active and what it does. That's a top quartile fund over 3 and 5 years and north of 300 million invested in it. And clearly you can also access it via a segregated portfolio of investments, which is, if you're a charitable investor today, you can't access via the CAIF. And so there are other investors accessing through a segregated portfolio of investments, and that could be single asset class, absolutely.
So that was a very nice question to be asked.
Thank
Ben,
you.
a slightly tougher one for you. When you actually do your analysis, which takes precedent? Climate risks to the downside or opportunities to the upside?
Yeah, it's a good question. I mean, I suppose it touches upon what Al said earlier, which is to say when we consider all the investments that we make on our clients' behalf, climate risk sort of permeates our thinking on those investments. So the climate risk approach does not limit itself to just companies with high emissions footprints, whether that's scopes 1 to 3, like electric utilities or fossil fuel producers. It considers banks, financial services. It considers companies involved in various industries, the agriculture value chain. So it is very far-reaching. And then, as Al also mentioned, when we think about looking for opportunities, climate change is one of our core 5 mega themes, and we have 5 sub-themes that we think about to best allocate capital towards as we make the transition.
And actually, probably Ben again. Again, we've made the point that we've actually sold out of the conventional fossil fuel companies, but people asking, could integrated oil and gas businesses become investable for you again? Sort of if so, when? Is there a valuation level at which all the risk to their businesses is priced in, or is there some sort of inflection point where renewables exposure starts to outweigh their historic fossil fuel exposure?
Sure. I mean, it's a slightly complicated question, but when we think about it, clearly what we want to see, given the scale of capital that's required globally to decarbonize the economy, we need fossil fuel producers to make that transition towards providing low and zero carbon energy. So they are welcome partners in that transition. For our approach, we have not seen a sufficient realignment in the capital allocation of the integrated oil and gas companies globally that we want to see, that brings them in line with the Paris Agreement. Of course, that is possible, though there then remains some sort of secondary questions about the capital structures of those businesses, the cost of debt, the cost of equity of those firms, and whether it's appropriate for them to make that transition profitably.
Okay, now here's a big one which a couple of people might want to comment on. Is continued economic growth even possible with the carbon targets we are setting ourselves? Some would suggest we're going to find it hard to decouple economic growth and our emissions. Cameron, do you want to kick off on that with your sort of leading global climate economist hat on?
Sure, thanks, Richard. It's a question that I'm getting asked more and more. Actually, I wrote on this, did some analysis about a decade ago and published a little paper on it, but I think I need to dust that off and publish an update. I mean, the bottom line is that, yes, it's kind of hard to decarbonize while we're growing, but I'd say it's even harder to decarbonize while we're not growing, because you need the politics to align and you need the surplus funds to make the investments in clean technologies and make the transformation. I'm often hit by this statement that we've seen no evidence of decoupling. Ben might want to say something about the fact that on a country by country basis, you do see that evidence of absolute decoupling. Globally, that's true. We haven't seen any evidence of that yet, but we haven't seen any evidence of being able to do it while we're in a recession either. Certainly not a sustained recession of 30 years, and whether it makes it even more or less feasible, I would say less feasible. It's certainly not desirable to have a 30-year-long recession. It tends to make people kill themselves, they lose their jobs. There's a lot of human misery when your economy tanks. So I think it's just worth environmentalists keeping in mind the fact that while we do need to change the model, for sure, the economic model we have now is not okay. It's not fit for purpose. The change that we need isn't to destroy the very foundations of our prosperity. It's to clean up the way we do things. And that is a more prosperous, possibly, certainly wealthier, possibly even higher growth and cleaner world that we need to head towards.
Natasha or Ben, do you want to comment on that one as well? It is a huge question.
Yeah, I mean, I would only add, I thought that was an excellent answer. So I would concur with absolutely everything that Cameron said. I would only just also pose a further question, which is that, look, if we don't, then we won't have the economic growth to drive future prosperity. In other words, if we continue in a business as usual way, the economic growth itself will be undermined. I mean, the way economic growth is measured today is very narrow. It leaves out all the impacts we have on the environment, on society in a broader sense. But even that narrow metric, I think, will start to suffer in a very meaningful way if we do not decarbonize.
Ben, do you want to add anything to that?
Yeah, only to sort of reiterate what Cameron said again, which is it is possible to decouple economic growth from emissions. We have seen, very recent analysis that we can share with attendees that points towards, I think, 34 economies globally having done that over recent decades, including the UK and much of Europe. Legitimate questions about to what extent those emissions have been offshored to China and elsewhere. But that decoupling, certainly from an emissions perspective, is possible. From a resource consumption perspective, the answer is slightly more complicated.
Okay, one here possibly for sort of Alan and myself. I'll go first. You've talked a lot about the public companies you invest in via equities and bonds. Should we be looking at private markets, so venture capital, impact assets? To which the answer is absolutely yes. I think the majority of a portfolio like this for us is always going to be in the liquid and listed asset classes, but definitively we've got the ability to put at least 15% of the portfolio into alternative assets, and some of those alternative assets will definitively be private equity, venture capital, when we can see opportunities. I just think we've got to be very careful because some of the very early stage investments have proven an absolute graveyard. If I think back to solar panels and that type of thing at the beginning of this movement. So yes, there are opportunities there, and when we see them, we will invest in them. Another one, Al, how do you actually handle reporting engagements to your clients? How do you report on that? To what degree do your clients actually have an influence on what you're doing, if any?
Yeah, it's a really key question, isn't it? Because at the end of the day, the individuals and organizations that back the fund need to understand what we're doing with their capital. So for us, reporting is about providing proof points for them and for their stakeholders, and that comes in the form of individual updates within the quarterly report, focusing on specific climate issues, so on a quarterly basis. We also have invited investors to co-file resolutions or to co-sign resolutions with us on a number of instances, and indeed, some investors have participated in conference calls directly with some of the investee companies. So there's a range of sort of ways that they can get involved, from the standard reporting right through to being right at the coalface, if you like, for want of a better word, with some of the engagements themselves. And we're looking to continue to do that and indeed ratchet that up.
Okay. Heidi, you talked about the inefficiencies, and I suspect this came from the heart. There are so many metrics and frameworks that you're being fired at and being asked to answer and fill in huge submissions. Is there actually a framework or a particular set of measures you feel we should be focusing on to make your life easier and to get all companies reporting in some form of similar fashion?
Yeah, I mean, and maybe just to provide a little more context to what I said in the presentation, if I think over the course of the past year, we've had engagement from sort of 14 different companies that have ESG platforms that do rankings of companies, all of whom want to engage and want to obtain data from us. And so, as you can imagine, going through this can be quite sort of resource intensive. Probably the one that's most comprehensive, the one that's so we see most interest from our investor base in is the Carbon Disclosure Project. So not only is it the most comprehensive, but it's probably the one that also gives us the most freedom to explain our answers and our data. And so in that sense, we probably find it the most useful. I would say it is very comprehensive, but we submit about 100 pages worth of data just for a carbon disclosure project. So it also gives you a sense of the sort of the order of magnitude of data and information that is being requested of companies.
I mean, Natasha, can I follow that up with one of my own to you? Is the investment community working together to try and get companies, asking them the same questions as opposed to everybody asking them their own variation of the same question? To what degree have we had the progress we have had because the investment community is working together, and should we work together more often? How does that work?
Yeah, so there is progress is a simple answer. In fact, you've now had the International Accounting Standards Board Foundation trying to work with SASB and others who are sort of generating ESG data, if you like, to come to an agreement on a sort of a shared template so that you do get more consistency and then with that comparability. I actually am of the view that will be incredibly helpful, but I'm not sure we're going to get away from these different surveys. Maybe I'm wrong. Everyone's always got a different angle on something and thinks somebody else is missing something so that they can get a better insight. So I think that diversity, and indeed I think it's healthy, right? I think we're in a competitive market for information, and having that diversity actually generates a certain level of competition, and hopefully through all of this experimentation we will get that insight. But there are efforts, and so I think people will start to see the benefits of that coming through in coming years.
Cameron, if you could choose a couple of mechanisms that would speed up and be the most impactful to get climate related matters just moving more quickly in the right direction, are there a couple of metrics, like carbon pricing, that you think would speed up the transition?
Not to lead the witness or anything there, Richard. But yeah, I carbon pricing is a good one. But we have, for interested parties can have a look at a report for the Committee on Climate Change from the Policy Advisory Group, which I chaired, which looks at sensitive intervention points. So if you can make a small number of interventions in this system, what would you choose to have the greatest outsized effect? And actually some of the things that Sarasin is doing qualify, in a sense, the changes to auditing rules and others. But in terms of wide, broad, deep incentives, there's nothing like a carbon price. Of course, the challenge is getting it into place. I'm very excited that the Europeans have put the border carbon adjustment mechanism on the agenda. I think if we could get the Americans lined up with that too, then you'd have a huge chunk of the world's consumers covered by carbon pricing that would then cause the dominoes to fall. So that could have a disproportionate effect. I mean, the other thing I think really helps is thinking sectorally here, because actually a lot of the competition and the concerns about, are we going too fast or too slow, that you're not worried about whether, the renewable energy sector in Chile is going too fast or too slow compared to you if you're a food producer, meat producer in Britain. You're worried about your direct competitors in your agricultural industry. So thinking in these kind of sectors and getting sectoral solutions can really help. I guess one more thing, just to probably overstay my welcome, is Bill Gates has his green premium, and I don't agree with all of his book, but I think the bit that is certainly right, we've been tracking this, is that judicious investments in pulling down the costs of clean technology can go a very, very long way and have a big leveraged effect on the transition.
Okay, I've literally got a couple more because we're about to run up against our time. So for anybody, Cameron, you mentioned it, but it impacts on others. We've talked about carbon capture and storage. Is much progress being made on that front? Because that's a pretty integral part of most models.
Yeah, I mean, whether we like it or not, you go as fast as you can on reducing emissions. We're still going to have to be taking greenhouse gases out of the air now in the middle of the century. And that's the sad truth of where we find ourselves. And I wish it wasn't the case. So it's an important question. How are we going with mechanisms to directly capture CO2 from the air and bury it? CCS, carbon capture and sequestration, as a kind of end of pipe solution for renewable emissions. It's probably not going to play a huge role in the power sector because it's going to move to zero emission sources in the first place, but it may have a role to play in a bunch of industrial sectors where you already get quite concentrated streams of carbon dioxide. And the other thing that's moving along really rapidly, and the UK government is about to put very significant resource into exploring, is how we can take CO2 out of the air and return it to nature to get the carbon back into our soils. We've taken a lot of carbon out of the soil, so kind of nature wants the carbon to go back in. Can we accelerate that natural process? Can we use rocks and weathering of rocks? Can we not only stop the deforestation that's happening, but reforest? So all these things to take carbon out of the atmosphere and put it back into nature are helpful. I've got colleagues who say, it's not the solution because the carbon came from the rocks underground. We've got to get it back there because there's a natural interaction between the biosphere, the plant life, and the atmosphere. But if we buy ourselves 50 years by taking CO2 out of the atmosphere and putting it back into the biosphere, that's enough, I think. I mean, 50 years, it's very, very valuable at this stage of the game to get that breathing space. So there's a lot of work going on in that area right now.
Just a quick one for Natasha. Do you think COP26 is going to be as influential as Paris? And given it's taking place in the UK, presumably there's going to be a lot of noise about it. What are your feelings? Just a brief comment on COP26.
My brief comment, Richard, is I hope very much that it will be. I think this is the key moment for the world to sort of actually step up, ratchet up their ambition, given a much better understanding of the science. And, we have our role to play, and we're starting to see sort of major parts of the private sector step up and make net zero commitments. So I very much hope that it will be.
I think that's a positive note to end on. And there was a good question here, just pointing out that, as investment managers, should we ourselves be leading the way and setting an example? And if you're interested in what we at Sarasin & Partners are doing, then go onto the website, because we write up a sustainability report to show the degree to which we are trying to focus on this and behave better ourselves and monitor our travel. And actually, in the last 12 months, these virtual events have had quite a meaningful impact with the lack of travel that they involve. I think at that point, it's actually 30 minutes past 10, so we've overstayed our welcome by 3 minutes. But I'd like to say thank you very much for all the internal speakers from Sarasin & Partners, but also particularly to Heidi and Cameron, and the kind words some of our clients were willing to say at the very beginning. But look, thank you so much. Everything will be available on this DUSRA platform for the next month. So if we sped through a few things, that there's the opportunity to go back, rewind, pause on the various slides. And it will also be available on our own website in the next couple of days. So on that note, thank you for your support so far. We've taken this from nothing to 900 million over the past 3 years. Here's hoping that we're talking again in 3 years' time with another trebling of the assets, and we're running a short 3 billion, because none of the issues we've talked about today are going away. In fact, they're going to get more and more focus, and I can't see how this isn't going to influence our portfolio performance in a major way going forward. So thank you for your support. Thank you for your time today. And I look forward to seeing you hopefully in person in the near future. So goodbye from me and goodbye from everybody else.